Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we finished up our module on the logistics of stock trading with a look at how to place a trailing stop. In today's lesson we're going to start a new module covering the basics of trading stocks on margin. So let's get started.
Like the concept of short selling, trading on margin is one of the more confusing concepts that traders encounter regarding the logistics of trading. Trading on margin very simply involves the use of borrowed money from a trader's broker, which increases buying power and allows traders to amplify both their profits and losses. To help understand the concept of margin, let's start with an example that many people are more familiar with: getting a mortgage to buy an apartment. For this example, let's say there are two people who are buying apartments in the same building, each of which costs $100,000. The first buyer in our example pays the full $100,000 purchase price in cash. The second person does not have the full $100,000, so instead he puts down $20,000 of the purchase price and obtains the rest of the $100,000 cost of the apartment by obtaining a loan for $80,000 from his local bank. Next, let's say that over the course of the next year, the price of both apartments goes up by $5,000 to $105,000. While both people in our example have a $5,000 gain on their apartment, the percentage return on their money is quite different. For the buyer who put up the full $100,000 purchase price, the $5,000 increase in the value of the property represents a 5% gain on his money. For the buyer who put up only $20,000, however, that same $5,000 increase in the value of the property represents a 25% gain on his money. Now that we understand this, we can see the reason why some traders choose to trade on margin, so they can try to amplify the gains on their capital when trading in exactly the same manner as I have outlined here with these two apartments. While the ability to amplify one's gains through the use of borrowed money is certainly an advantage, it is also important to understand that trading on margin is a sword that cuts both ways. In other words, just as the use of margin amplifies the gain, as you can see using the above example, if the price goes down by $5,000 instead, losses are amplified as well. So to take a stock trading example, let's say that we have two traders, each of whom buy 100 shares of stock that is trading at $10 per share. The first trader trades an account without the right to use margin, which is known as a cash account, so he needs the entire $10,000 purchase price of the stock available in his account in order to buy the stock. The second trader trades an account with the right to use margin, which is known as a margin account. This trader is able to borrow up to 50% of the purchase price of the stock, so he only needs to have $5,000 in his account in order to purchase the same $10,000 stock. If the price of the stock trades up from 10 to 11, then both traders have a $1 per share gain on their 100 shares for a total gain of $100. While this represents a 1% gain on the first trader's account, it represents double the return, or a 2% gain on the second trader's margin account. To simplify the example here, I have not included commission costs or the cost of the interest traders pay on margin accounts, which we will cover in coming lessons. Also, keep in mind here that if the stock had traded down by $1 to $9 instead, then just as the percentage gain on the margin trader's account was double, the margin trader's loss in this example would be double as well. Because trading on margin increases the risk on a trader's account, there are additional rules and regulations that we must be aware of surrounding the use of margin, which we will learn about in our next lesson, so I hope to see you then. As always, if there are any questions or comments, please feel free to leave them in the comment section below, and good luck with your trading.